Today on Open Exam Prep, we're covering a topic for the Securities Industry Essentials exam, often just called the SIE exam. We will be dissecting variable annuities, specifically their features and how they are taxed. Let's begin with one of the core insurance features of a variable annuity, the death benefit. On the exam, you will need to know that if the contract owner dies during the accumulation phase, their beneficiary is guaranteed to receive a certain amount. Typically, this is the greater of the total contributions made to the annuity or the current market value of the account. For instance, if an investor contributed $100,000, but due to a market downturn, the account is only worth $80,000 at their death, the beneficiary would receive the full $100,000. This feature provides a level of protection against market loss for the investor's heirs, a key distinction from a direct investment in mutual funds. Of course, these insurance features come at a cost, which brings us to the various charges. The SIE exam will expect you to be familiar with these. A major one to watch out for is the surrender charge, also known as a contingent deferred sales charge. This is a fee an investor pays if they withdraw more than a specified amount before a set number of years, often 7 to 10 years. A typical question might present a scenario where an investor wants to withdraw a large sum in year 3 of a 7-year surrender period. They would face a penalty, perhaps 5%, on the amount withdrawn. This fee declines over the surrender period until it eventually disappears. Beyond surrender charges, variable annuities have mortality and expense risk charges, often called M&E fees, which compensate the insurance company for the risks it assumes. Like the death benefit guarantee, there are also administrative fees for record-keeping and other overhead costs. These combined expenses tend to make variable annuities more costly than comparable mutual funds. A primary attraction of a variable annuity is its tax treatment, specifically tax-deferred growth. This means that any dividends, interest, and capital gains earned within the annuity's subaccounts are not taxed annually. The money is allowed to grow and compound without being reduced by taxes year after year. This is a significant advantage compared to a standard brokerage account, where investment income and realized gains are typically taxable events each year. The exam will test your understanding of this core benefit. However, the tax picture changes dramatically when money is withdrawn. For tax purposes, withdrawals from a non-qualified variable annuity, meaning one funded with after-tax dollars, are treated on a last-in, first-out, or LIFO basis. This is a critical concept for the exam. To remember this, think, LIFO makes your gains leave first. Oh no. This means all the earnings, which are taxable, are considered to be withdrawn first. Only after all the earnings have been taken out can the investor begin to withdraw their original contributions, which are returned tax-free. For example, if an account has $100,000 in contributions and $50,000 in growth, the first $50,000 withdrawn is fully taxable as ordinary income. Furthermore, if the investor is younger than 59 and a half, those earnings are also subject to a 10% federal penalty tax on top of the ordinary income tax. This LIFO treatment is a common trap for test takers who might assume a more favorable tax treatment. So remember, earnings come out first and are taxed as ordinary income, not as lower-rate capital gains.